Hey there, how you doing? Welcome, welcome back to the channel. So today, just messing around a little bit here in my world. Stupid bat. Yeah, so look like today, stock market stuff. We had market kind of recovered, went up today. Apparently, we have some. Yeah, kind of interesting. I don't know what's going to happen. Apparently. The TGA account is they're going to be using that money, going to be giving that out. So there's a lot of videos talking about what the effect of that would be. So I don't know. I just have a feeling that it's kind of like it seems like there's a lot of more money coming out, and so this should be positive. I think the did that bill get passed? That stimulus bill? I think it did. And so, I would expect a repeat of what happened last time, which is basically a lot of people took their money and put it into Robinhood trader accounts and started gambling in the market. So that would be my guess what's going to happen. But I don't know when. I don't know what the timing is of that. So I need to look that up. Let's see. Let's see what's going on here. Okay, so let's go look at stocks here. Let's see what's going on today. I'm going to share this guy here. Okay, so yeah, so okay, well, let's start with the big picture with the stock market. So here's the big picture of the stock market. Let's go to a weekly chart. So here we are, weekly chart. So it's interesting. So if you look at the SPY, you can see that, what happened last week was really nothing. There's very little actually happened, even though there was a lot of talk about how far down it went, et cetera. So at least in terms of the SPY, that wasn't the case. If we look at the Nasdaq took some more damage here. So there's the 10-week moving average, which is whatever that is, 50 day. It's kind of equivalent to the 50 days. So you can see that it broke the 50-day moving average last week, but now it got back above the 50. So once again, zooming out, looking at the big picture, really not a lot of damage done, at least on the indices. Looking at the 10-year yield, this is kind of what started the problem last week, is that the yield spiked up on the 10-year, and apparently there was a bad auction or whatever like that happened. It kind of spooked the market. And so you can see here on the 10-year yield, so basically the higher the yield, the lower the price. So the implication is that, the higher the yield is going, that means the lower the price. There's less demand for those bonds. So here you have rising rates at the 10-year. So it kind of came off a little bit, but not a lot. It's kind of interesting. It's like, okay, yeah, it kind of got way out of control there, and then it got hammered down. It came back down, like kind of got knocked back into its sort of into the channel, but it's still way up there. So we try to draw some channels. Just trying to get a feel for the channels here. Yeah, you can kind of see that. And these channels are always kind of fluffy. Normally you need like 3 points coming down to kind of draw a channel. But you can see here that it came out, and then it's still really high, so it's kind of interesting. So even though the market recovered really good today, the yields are still being persistently high. Yes, they came off from the highs of last week, at the end of last week, but still, they're still kind of persistently high in the upper end of this channel. So that's kind of interesting. There's something to watch out for, to see what's going to happen with that. And then let's look at other stocks. So Apple today, look at that move on Apple, 5%. Ooh, I don't have any of that. I don't have anything on it, which is good, I guess, but it would have been nice to have maybe have a little bit to put some on. But let's see. I was going to look at the three. Yeah. Yeah, here, this kind of thing, you see it comes off the moving average here, the dotted line, which is, well, actually, that's interesting. That pink dotted line, that's a 150-day moving average. So it's really long dated moving average. Kind of came up Yeah, I don't know how you would buy that. So I don't know. FedEx from last week, still, I got in and out of this thing. I'm out of it, lost some money. It's still not really breaking out very strong. I mean, this thing is really got to break above this high here, 260, whatever the high of that day is, 265. So it's not really doing that yet. So that one's just kind of crapitola. Let's look at the Grayscale Bitcoin Trust, and we can look at Bitcoin too. Yeah, kind of interesting, right? It's interesting. So, looking at this version of the Bitcoin, which is this trust, they definitely not like a double top. Like I was talking, like it could have been back here, a double top, but it's definitely, that's not the case. I mean, the uptrend is still in play. It's still in the uptrend. I mean, we're still trading above all the moving averages, the 25 and the 50 day. They're kind of compressing together a little, but they're still, going up. So, and what's interesting too, if you look at your stochastic, your slow stochastic, you see how it's starting to turn, as if the correction is kind of maybe coming to an end. Now, the thing, yeah, so you can see here on the stochastic, overbought up there, you're overbought when you're above 80, and then it crosses over like that, the red crosses over. Then as you get down to here, oversold, you see the black line crosses over the red. So it's kind of interesting. So like you kind of get to like when it's at the moving average and it's sold off a little bit, and you get this kind of crossover, the black crossing over the red, it's a good place to maybe try to buy some. And so this is not financial advice. This is just paper trading. That's it. Nothing. I'm not doing anything. But theoretically, that's where you could buy it. And see, what's interesting though, the stochastic is kind of like, if you look up here, it's got a percent K10 and D3. Honestly, I don't know what that is. I used to know all the formulas, and you should look it up. But the point that I'm going to try to make here is that, people like use this stuff and they're like, oh, use the moving average and this, that. But what you have to understand is what you did is you fitted it, right? So this is like, you can change this D to anything. Like this is like some kind of 3-day, I think it's like a 3-day moving average over this, the K, which is a 10-day, something like that. And so you can change these parameters. You can go in there and change how you program them. And, in the moving averages, you can look at the 20-day, 25, 50, you can pick whatever averages you want. It's important to understand that there's sort of industry standard ones. So that's important to understand, like the 25-day or the 20-day and the 50-day, 200-day moving average. Those are, pretty standard. But so that's kind of important to kind of use ones that are more familiar. But like a lot of people are using kind of, and like the RSI, here's the 14. I mean, it's the 14-day RSI calculation. And, you can use whatever you wanted. You could change these parameters and everything, and then that would give you kind of a different signal on it. So what that really means, see, like it's not an absolute thing, it's a relative thing. What that means is you're fitting it. And this is what happened back in the 80s and stuff. I think, yeah, I was doing trading in the 90s. And you read all the books from the 80s, and they, they had like crossover systems and stuff where like, oh, the 25-day crosses over the 50, you buy, you sell when it crosses back. But the problem is, depending what's happening, like here you're in a consolidation, you kind of get whipsawed. You kind of end up coming in and out on the signals. And back like in earlier times, like in the 80s, moving over average crossover systems worked pretty well for a while. But then everyone knew about them, and so they kind of changed. Everyone kind of predicted the behavior, and it just kind of changes the behavior. So basically what it means is if you're detecting a signal and you're saying, oh, anytime I'm oversold and I'm coming off the moving average or hitting the 50-day moving average, I'm going to buy. If that's your signal, then what you're doing, and then you go, if you would back test it, okay, meaning you would go and try to get as many charts as you can and try to apply that system and say, I buy it, and then have a mechanism where you say, well, it goes over 80, you sell. And whatever your system's going to be, and you would experiment with different systems. But the point is, what you end up doing is you end up like you're curve fitting, what we would call it, like in engineering. What you're doing is you're taking the data that you have and you're looking at it, and you're just using that data to come up with a method that works. And it works for that data. in that period of time, but it's not always guaranteed to keep working. So it's definitely something. It's better than having no strategy. So it's good, but you just got to understand that sometimes it changes. And where this will change, like for example, right now we have a bull market. So like anything coming off, 25-day above the 50, you're coming into the 20 and the thing's got an uptrend and blah, 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 RSI. Like you can kind of make arguments. The way it's going, you can throw a dart at the wall sometimes with stuff that's not too high beta, and you'll make some money on it. But that changes. Like in a bear market, that stuff changes, and what'll happen is that will just fall apart. So I remember I was day trading for a while, and I was working really good for a couple months, and it was working good. But then the market changed. And basically the strategy I had wasn't working anymore. So, the problem is you have to realize, and I realized, and I said, okay, it's not working. So I got to stop doing that. You have to change your strategy. So kind of like trading is you need to have a lot of different strategies and techniques in your toolkit. And you have to be ready to kind of pull out the appropriate one for the situation. And the issue that you have is that, like, we've been in a bull market here from the March low, I mean, everything says buy the dip, right? So of course, all your trading strategies are gonna kind of be in that line of thinking, and you'll probably be okay. But then if you're in a situation here, this dip didn't work back here when we had the crash, right? So it didn't work there. But so the point I'm trying to make is that it does change. And so I guess what would be another example of things changing? Yeah, like let's zoom out to a longer term chart of the S&P. And what I'll do is I'll try to go into one of these earlier periods of time. Yeah, so here you can imagine, like back here in the run up to the tech crash in 2000, you were at a similar situation to what we're in now. It's just like, you get these corrections. Some of them are very fast and violent, but basically as you come out of these corrections, come off the moving average, you kind of always buy. But then it broke here. And then here now, like, you have nothing to go by because now the moving averages are going down. So you cannot, if you were using a simple strategy that was like, you basically do some buying, maybe you hold something all along, and then you do some buying every time it corrects to the 25-day moving average. And then you take a little bit of profits like 5 days after, something like that. That probably was working for you in here for the most part. But then over here, it's not working. Here, like every time it pulls away from the moving averages are going down. And so if you're buying it, you're losing because you're always making new lows on it. And so that's how things change. And then back over here, you see that the situation changes. Back in 03, like we finally get this low gets hammered out. And this is kind of what I would encourage you to kind of keep in mind with these patterns. So like a lot of people are into, like, I used to be into like, looking for head and shoulders and double tops and double bottoms, but like, here's the bottom in the 02, 03. What is the bottom here? Well, this isn't an inverse head and shoulders. This isn't anything like that to me. It's just a simple range, right? You basically, what happened is you were consistently making new lows, and then you come up, you rally up really hard, but then you fall apart and make new lows, rally up. And what's interesting here, the lows happen really quick, and they spend months coming back up, and then you fail. But you can see over here that, you kind of pay attention to these boxes, these ranges, right? So here it's like, okay, yeah, you couldn't get, like in this whole period of time from July to April, you couldn't get above this 67.5. You couldn't get above it. But you also couldn't really get below 55. So you can see that this is a wide trading range. And so now here's the setup, because the point is when you get over to here in your 03 and you're like, coming down to 55, is it going to break through? And it didn't break through. And you can kind of see it. See that strong bar? There's that strong green bar there. And that's sort of like like different strategies have different things that might be like a follow through day and stuff. But that's kind of a strong bar. Yeah, there was some strong buying in there. Well, you see it over here too, and then it sort of failed, but it held. And so that's kind of what that would be the kind of thing I would try to look for instead of looking for specific patterns like double bottom, double top, triple bottom, triple top, head and shoulders, reverse head and shoulders. You just kind of look for ranges, and where it consolidates into a range, it gets range bound, and then look for it to break out of the range. And that's an area where you can try to make a move, basically. So that's kind of a thing to keep in mind. That so I'm thinking about Bitcoin too. I'm really in the camp that it's a speculative asset, and it's funny, I hear these debates, and you have like the Peter Schiffs of the world that are like, it's nothing, and then everyone else is like, it's an asset, and I buy the Peter Schiff argument in a way. The fact is, there's like, okay, it's supposed to be only 22 million of them. Well, what does that mean? It doesn't mean anything, really, because there's an infinite amount of cryptos out there. There's an infinite amount. So, Bitcoin is the one of the moment, who knows, Ethereum, Dogecoin. There's hundreds and hundreds of coins. Who knows what's to say like 2 years from now that some other coin is going to be the new top dog, That's one. And then the other one that's kind of interesting is I'm kind of wondering what happens when they get to the last Bitcoins. I assume it's asymptotic. And what that means is, like, when you have a curve, if you saw, like, you have all these curves in nature, like I'll show you a normal distribution. Yeah, so if we go to Wikipedia here, yeah, normal. So this graph over here, this is, this would be a graph of a normal distribution, right? But here's the thing. So if you look at this and you see how it tails off, probability density, is high, 0.4 here, but then it goes off to 0. But the thing is, it never gets to 0. So that's what asymptotic means. This curve keeps going and going, and it gets smaller, 0.01, 0.001, blah, 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 but it never gets to actual 0. That's called asymptotic. It goes off asymptotically. And so that's kind of what I wonder if what's going to happen with Bitcoin. Like, they can never issue the final Bitcoin, right? So because they always have to have some way of rewarding people for mining it to validate, the transactions. And if they actually give away the last Bitcoin, why would anyone validate the transaction? Not unless they come up with some new way of dealing with it or something like that. That's one thing I don't understand. Then the other thing is, like, look, it's only the the interesting thing is, if you look at gold, you can say, like, gold is like, look, it required actual physical resources and labor to get the gold out of the ground, and that's true. And then Bitcoin, did it take anything? Well, it did. It took physical computing power and actual power running the computing engine that you're using to mine it. So it did require some of that. But on the other hand, the cryptocurrency has no other use. It literally has no use. It has no use. There's no use for Bitcoin other than to use it because other people want to buy it from you in exchange the Bitcoin with you. If that stops and they don't want it anymore, then it's not worth anything. So I sort of buy that argument, but I do have some, and I'm going to continue to ride it too, because I'm like, hey, if you're in the tulip, that tulip bulb bubble that they had back in whatever the 1700s in Holland or whatever it was, you can look it up. And it's like, yeah, tulip bulbs were like so expensive and everyone was buying them. And it's just a huge bubble. Now, tulip bulbs, at least they have something, but all they're going to do is grow a tulip, which is a nice plant, but still, like, buying a house that could have a bunch of tulips around it. Why were people buying tulips? They're only buying it because they don't care about the plant. right? They can grow their own tulips. They don't even need a tulip bulb. They can find them. I mean, they're in Holland. They plenty of tulips around. So why do they want the tulip bulbs? They just want them because they want to make money on it, speculating. They want to sell it to someone else for more. And that works until it doesn't work. So I think that's where we are with Bitcoin, because there is no utility to it. There's nothing backing it up. And another interesting thing about it too, because you look at how they used to make fun of gold, and they would say, hey, gold is a barbarous relic. And one of the things they point out that is valid is that, hey, gold doesn't pay you a dividend. It doesn't pay you a return. So if you put $1,000 into gold, you're not getting a 2% return or 5%, you're getting no return on it. It's just, you just put the money there, right? So once again, the same sort of thing applies. Like, well, why did you buy it? You bought it. Why? Because you hope that someone will pay more for it later. You hope, and by that, you're hoping to preserve your purchasing power, not unless you're in industrial use. I mean, it is used in the industry and stuff like that. So there seems to be some kind of a floor there, right? Because you use it in electronics and other things like that. So, but it's not a huge amount of use. But for jewelry and things like that, there is use for it. But a lot of that is speculative as well. So so I just, Bitcoin is going to blow up, but just the question is when. It's really hard to tell when. I think it's got a lot more to go. Okay, our GameStop. Wow, it really, it went up today, 18%. Talk about crazy volatility. So we'll see what this one does. I mean, my gut feeling is that it's got nowhere to go but down, because just the nature of this, it went all the way up to here, 400 or 500 back here in February, early February, late January. I mean, I don't think it gets up into there. Here's a great example of resistance of a gap, See, you have over here back in January, February, like I was pointing out this one time, this whole gap, this big gap between like 150 and the lower the candle here, this 190, let's call it 200, so 150-point gap there, where very little trading occurred. I mean, there was intraday, there was trading here, but it wasn't an open and close in there. And if you look at that, it kind of creates kind of this abandoned kind of top, this island, sort of this island up there, very sloppy, ugly kind of island up there. But see over here, what just happened last week is we came up into it and we really hit a wall of resistance. I mean, it came up into it pretty decently. It got halfway through the gap, but it couldn't make it. And so now, then it kind of went down, and then today it's up 18%, but it's really didn't make much progress. So yeah, I don't know. That one's kind of a mess. And then Tesla, wonderful. Not bad day today, but look at the volume's very low today. So not sure what to think of that. You do have to be concerned with volume, because like, up days or days on low volume seem to have like less conviction with them. So that sort of points to the stability or the sustainability of the move. And so that's what you have to kind of really watch out for. What's Peloton doing? Look at this Peloton. I lost money on this stupid thing. But this is just, it's not really going anywhere. PLTR, what's this thing doing? SOS, what is this thing doing? Oxygen. A lot of these stocks are not really moving that much. AMC, what is this one doing? Up 14%. These are kind of weak moves. Like the AMC and the GME are really kind of weak moves. I mean, 14% up. Oh, that's a big move, and it is percentage-wise, but it's not really light volume. I mean, you got to look at it. Look at this day. This day when it sold off, when it hit 11 and sold off, it generated 400 million volume traded, 400 million shares. And then today we're up 15%, but you didn't even break 200 shares. So, and this is what's called distribution here on these 3 days. I'm sorry, accumulation. So here, the way they look at it is like if you go from this day here And then the next day you had an increase in volume over the previous day on an up day. So that's called accumulation. Then the next day you had more accumulation, another up day, increasing volume, up day, another accumulation. Then over here you had a distribution day. You know, you had even more volume. You know, what's interesting about that is, like, you know, if you add up all the volume in there, 400 something million, well, they didn't sell off all those shares, but sold off a chunk of them. You know, so that's a distribution day. And then this isn't really accumulation or a distribution in here. It's just sort of, but it's very low volume, very weak. So yeah, it was interesting. I was reading an article too about the, there's some study on this GME, and they looked at things. And of course, this study is really suspect, but they're talking about how, like, oh, they believe it was bots that were, you know, talking up GameStop and all that. And I didn't really buy it because they're like, it's really honestly the dumbest logic in the world. They're like, okay, they go monitor websites and groups and stuff, and they're like, oh, the activity for GME, the number of mentions of it goes rapidly up just before they open, and for another hour or two, and then it goes away, and then it comes back before the close. And they're like, well, this is a sign of automated bot activity. I'm like, really? No, it could be. You know, that's one of the things that I've said, that, like, people talk about, oh, this is the little guy taking out the big guy. And I'm like, I would not be surprised that there's a big guy behind there. Like, all this WSB and all this stuff, like, it's all crap. That I wouldn't be surprised if there's a big guy behind there, a hedge fund behind there that's like, oh, we got a new strategy to get people to help us do the pump and dump. I wonder about it. But the logic of this report was just silly, because it's like, look, if you're looking through a newsroom, like a bulletin board or Wall Street Bets or something, what are people doing? Well, they get up in the morning and they're doing other things, and then they're like, okay, we're going to go ready to trade, and so they start talking about it. I mean, that's typical of any trading group. Is like before the market and after the market, the first hour, maybe even 2 hours, and then it goes away, and then people have stuff to do and they go do stuff for the rest of the day, and then they come back for the close. That's pretty typical trading behavior, right? So their whole conclusion that it was bots is really silly. So I think you have to really be careful with that, because it's funny, because people will put out a report, it could be a very flawed report, and then they quote it as if it's fact, and whether this is fact or not, I cannot say. I don't know, but I think it's worthy of being skeptical of that. So yeah, so I think that is it for it. We'll kind of see. Yeah, so that's the word for the day, asymptotic. And well, I'm going to show you this. I'm going to show you this version of the normal distribution. So over here, so you can look at this distribution here, and you can look at this, and this is the kind of curve that you would typically see for the returns in a stock or in a stock market average on any day. And you could do it for anything. You could calculate the returns for a day, the returns for a week, the returns for a month or a year, whatever. And what the thing is, what you would see here is, like, for example, if you plot this curve where the y-axis is the occurrence, like how often it occurs, and then the mu here is actually in terms of the percentage. And so let's take these mu's, and what we're going to do, let's say the average return here, mu, is actually, we'll call it a value, 1% on any given day. So what that means is, what you would find is that most of the time, so if you took a whole year, 200 days of trading in a year, you might find okay, no, let's do this. We're going to make it really simple. We're going to take and say there was 100 trading days in the year. And we're going to say the x-axis here, these mu's, are really the percent returns. In this mu, we're going to call it 1% return. So that daily return is 1%, and 100 trading days of the year. So what does that mean? 68.2% fall within 1 mu, right? So 1%, the small range, whatever the sigma is, I forget what the number is, but the point is most of them fall around a 1%, and it could be this range here, let's call it plus or minus 1%. Okay. And that means out of 100 days in that trading year, 68 of those days, it'll be within plus or minus 1%. And then if you look out here, well, what about 2%? Well, out here, this yellow, that would be the 2%. And then out here would be the 3%. So what you would see, what the point is that how often does that stock or that indice trade beyond, goes out and trades either up or down 2%? Well, the amount is much less, right? Because it's this little yellow portion, right? Most of the time, 68% of the time, it's going to show up in this 1 mu range, right? This 1 sigma, pardon me. And so this is really the concept that I was trying to break down, and I haven't collected the data yet, but I will. I'm trying to make this point where people will get into a stock and it'll be up 10% and they're buying the stock. And a stock that's up 10%, you can do the numbers, that's pretty rare. I mean, yes, we're seeing a lot of that right now, but that's, this graph changes for the group of stocks you pick to analyze, and it changes over time. And so the point that I'm getting at, so if you buy stock, for example, you buy a stock as 10%, you're already way out here in the red. You're very low probability. And what that means is, see the 99%, but you just have to look, the only time it's out there in the red is this little red sliver. So it's really 99.7 minus 95. So it's only like 1% of the time it falls out there, where it's either plus or minus that large amount. So the point I was trying to make, the point I was really trying to get to was that if you're buying a stock that's up 10% or you're selling a stock that's down 10%, you're in a low probability situation right from the start, because you're already in a situation that only occurs 1%, 2% of the time. Do you see that? It's right here in the graph. It's like it only occurs a couple percent of the time in a year, right? So so now when you buy a stock and you say, oh, I'm buying a stock and it's up 10% and I want it to go to 20%, I'm hoping for it. What's most likely going to happen? Well, the reality is you have a much higher probability that it's going to go back down and fall into the plus or minus 1% range or the plus or minus 5% range, some other lower range, right? That's the reality of the situation. So that's why it's very dangerous. It's good to kind of get an idea of the range of the stocks. Now, the range of the stocks, if you're doing this high beta stuff like the Meet Kevin dude, it's going to be much higher than a standard S&P stock. So it may make sense, like buying something 5% up and having it run. It may be okay probability to do that. Yeah, it may be worth the risk return because of that. This whole chart is skewed towards much higher returns, right? But in general, it's not. So yeah, and then just point out one other thing. See, this is what they call the fat tail. See, this is how this curve should be. And I was just talking about asymptotic, how this doesn't go to zero. Doesn't go to zero. So you go out here and you have a plus or minus 100% day, a minus 200% day. What's the probability of that? It's not zero. And that's where they come up with the terms like, oh, this is a once in a lifetime or once in 20-year event. That's how they do it, because they're coming out and they look at this curve and you just do the math and you're like, okay, how often does this return? And this is data that they can calculate. So they can take the market and they can calculate this for all the data they have, and they can say, how often has it gone up or down by 50% in a single day? And it's like very low probability. And this is what that whole dude came up with, the fat tails. I think it was the Black Swan guy, but he came up with the fat tails because what he found is this thing, instead of continuing to go asymptotic, there was a little bump. And what he found is like, hey, these extreme events, which for example, might be a stock market dropping by more than 7 or 8% in a day, or a stock market dropping 10% or 15% in a week, like it should be really low, right? Because it should fit this kind of curve. It should be very low probability. But he noticed when he looked at the data, it's like, hey, there's a bump there. So that's what they call if you ever hear them say fat tail event, that's what they're talking about. They're talking about this curve under a normal distribution. You should rarely have these events, but what he found was that they occur more often than you think. The data showed that, because you basically run the data for the market, compute this, and he found this little tail out here at minus whatever it was, minus 10 or 15%. It's like, huh, that's more likely than I thought. And of course, I kind of threw things into kind of a tizzy because it's like, okay, that's not supposed to happen. Why is it happening, right? So now if we go back to our big picture, what are we talking about? What are we talking about? What's happening? Well, we're talking about this. We're talking about, why did the market go down like that? Why did it go down like that? Why were there these big days here? I mean, you had a big correction here. These were like really bad, sharp days. There's sharp days in here too. But the question is, why did you get those volatile days? Why did we get this stuff? These should, if I looked at this chart and I was going to look at data for 100 years, these should not have occurred, right? I mean, I'm looking at well over significant events, one, maybe one, let's say three events. I'm going to say this one here, looking as a sharp sudden correction in one day here, and here, 3 events out of 20, call it 30 years, 3 events out of 30 years larger with that kind of large decline. And if you kind of looked at stack data, like over 100 years or whatever, the entire history of it, that should probably never have happened in that time frame. It probably never should have happened, but it did. The data's there, it did. So that's the fat tail. That's how it affects things. So this is really an effect probably of just the way things are being run right now. We have like bubbles going on, and we have a lot of cash being put into there. We have stimulus, basically, the Fed is trying to get money into assets any way they can. And as a consequence of that, it's very successful in getting it into assets. But the problem is it creates instabilities. So that's why I think you see these big corrections. This one here, maybe it's a once in a lifetime, maybe. But, this was a pretty bad one. It was nothing. This one, pretty bad one. So I just don't know. Well, I think that's it for this one. I think I'll try to do some more to present something better on this type of curve and how that works. I have to look up and remember my statistics. Because like I said, this mu would be the average, and then here you're plus or minus 1 sigma of the average, and sigma is a calculation that you do. So what you can do is you can just calculate the average of the overall stock market, and we could do daily and say, and I'd get an average return for a daily return, and it would be whatever it is, 5%, 2%, or whatever it is, and then from there you can calculate based on the variation, all the variation data, and figure out what the sigma is, and then you can figure out all this data. So it's stuff that you can do in a practical sense. It's really, really practical. And the practical thing is, like, it's telling you that, you got to be careful if you've already bought something that's moved. And the other thing to keep in mind, and this was the whole premise behind gap trading. The whole premise is like, hey, you get a gap and it's out here in this yellow region. Most of the time, it's not going to stay out there. Most of the time, it's going to come back in. So if it gapped up, it's most likely going to give up some of that gain. And that's the whole premise behind it. So it gaps up, you short it. Gaps down, you buy it. That's the whole premise. So that's it for this one. This is not financial advice. Don't take any of my financial advice. Do your own research. I'm not a financial planner. That's it. Bye.